Hi everyone, welcome to my channel. I'm Doris. I'm here to show you about my stock account and today's market update. Let's talk about the Fed's our expectation for the Fed's rate cut later this year. A lot of the times that we have been assuming is that the rate cut will happen somewhere between March and May of this year. But have you ever thought about the possibility of not having a rate cut at all this year? So if that's the case, many other banks other than the Fed, the Federal Reserve of the US, may even do rate increases this year. In the face of market doubts, Deutsche Bank analysts gave two numbers in this week. So first of all, if the inflation stays at 2.7% or higher and unemployment hits 4% or lower, that could keep the Fed on a hawkish stance. So will the US economy's current conditions meet these standards? As of right now, it is not true. The year-on-year CPI growth in January is still above 3%, which is higher than expected and well above our 2% inflation target. Meanwhile, the U.S. January non-farm payrolls data shows that the employers added 353,000 jobs last month. The GDP also grew at an annualized rate of 3.3% in fourth quarter of last year, which also beat market expectations. First of all, the inflation has been showing in a more persistent trend, or in a way that is not as rapid decreasing as the Fed may want to see. At the same time, the labor market and the economy in general performed more resilient towards a recessionary monetary policy. This shows that the strong economic data may leave market participants wondering, what if Fed officials, led by Mr. Powell, chose to not cut interest rates? On the U.S. stocks market, BOA analyst said in a report this week that whatever the Fed takes, the S&P 500 may still be in a good position. In this report, the bank noted, "We remind investors that we expect strong returns for stocks this year, not because of what the Fed will do in 2024, but because of what the Fed has achieved since March 2022. As people began to be more proud or more visible to see, as the effect of the rate increases become more visible to more investors this year, that the stock market will show a more positive outlook for the U.S. economy. At the same time, the cost reduction from employment cuts last year may also will show gradual returns on the financial outlooks for the U.S. companies. Rosenberg research founder, economist David Rosenberg said, "There's a note saying that the country of the blind, one eye is the king. So, thus, in a relative sense, the best performing industry in this environment may be the healthcare industry, and then the consumer necessities industry. For the bond market, it'll be a very different situation. There is a 90% correlation between monetary policy expectation and the long-term treasury yields. If the investors could see the treasury yield to 4.7%, much from a multi-year high set at the end of last year, that this year they may be more cautious about the current bond prices and the choices of making large purchases to diversify their portfolio as the interest rate of 10-year yield continued to fall. This year, typical characteristics of the U.S. stock market are gradually falling into the stocks up, with treasury yields are higher, which is essentially different from the logic of the rally in the fourth quarter of last year. The market was basically stock up when the treasury yields were lower. Against a favorable backdrop of strong economic resilience to corporate earnings, people are said to be bearish on U.S. stocks, and the bond market is clearly doomed if expectations of a Fed rate cut fail. This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.